this money that the trade deficit creates has created a global credit bubble that's unprecedented in history. It's created not only an everything bubble in the United States, it's created a global credit bubble, a global everything bubble. Everything is a bubble. And the fuel that keeps this bubble from popping is the dollars that come as a result of the trade deficit. If you take away the trade deficit, this whole global bubble implodes.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast and YouTube show, Real Estate Market Watch, current events through a real estate lens. Now, my guest today is Richard Duncan. Oh my goodness me, he is absolutely amazing. I'm so happy that he agreed to talk to me. He is a world-renowned economist. He's written multiple books, including one called The Dollar Crisis, Causes, Consequences, and Cures, where he predicted with notable accuracy the 2008 global financial crisis. His professional background is that he's worked, I'm just reading off my notes here, global head of investment strategy at ABN AMRO, financial sector specialist at the World Bank in Washington, D.C., head of equity research at Solomon Brothers, and a consultant with the International Monetary Fund, the IMF, during the Asian financial crisis. Oh my goodness. Highly respected economist. And he is an expert in exactly the subject that I wanted to talk about. That is the power of the dollar as a reserve currency internationally and what the effect of the Trump economic doctrine will have on that. And most importantly, of course, what will be the impact of that on commercial real estate values and the way that we invest in real estate. So you are going to be getting a very high level understanding, well, high level in the sense of it being a deep dive. I'm not sure if you can have a high level and a deep dive at the same time, but that's what you're getting, both for the price of one today with Richard Duncan of Market Macro Watch. In our conversation, we're going to be learning a lot about the dollar and how its role in the world economy affects our investment decisions in real estate. If you have not already done so, please go to gowercrowd.com, subscribe to my newsletter. I will include a link to Richard's bio or some information about Richard and also to his LinkedIn profile. And he's very kindly offering listeners today a discount to his annual or to his Macro Watch newsletter, video newsletter. It is very kind of him to offer that and makes it extremely accessible. So I'll include a link to that on the show notes page for today's episode. But while you're there, do subscribe to the Gower Crowd newsletter as well, where I provide analysis of this conversation and of others in more detail so you can read it as well. And you can always unsubscribe, of course, all that at gowercrowd.com. Okay, let's move on to Richard Duncan of Macro Watch, founder of Macro Watch. Oh my goodness, stick around. It's a really good conversation, well worth spending your time. All right, here he is. Richard, what a pleasure seeing you. Thank you so much for joining me. I know you're on the other side of the world, which actually is perfect for the context of the conversation that we're going to be having today. And as I mentioned, I did a lot of preparation for today's call. And it wasn't until I had done all that preparation, then went to your website and saw your latest edition of Macro Watch and the latest video that you just put out with a list of questions that I realized that's exactly what I want to talk to you about. So with that in mind, let's start at the very top. As I mentioned before we started recording, let's start, if you don't mind, with a 101 explanation or kind of contextualize our conversation about the dollar, etc. What is this concept of exorbitant privilege? I think you've called it the dollar standard. Can you describe what it is, how it works, and why it's good for America?
So, Adam, first of all, it's very nice to meet you. Thank you for inviting me on the show. And so, yes, to the dollar standard.
Right.
The dollar is considered to be the global reserve currency, the main reserve currency. And the reason that is because the United States won World War II. And we had all the gold at the end of World War II. And we set up an international monetary system called the Bretton Woods system. The other countries, the idea was to try to revive international trade. But that was difficult because the other countries, for the most part, didn't have any gold. And under a gold standard, it's hard to trade if you don't have any gold. So the idea was to create all the other currencies in the world would be pegged to the dollar, and the dollar would be pegged to gold. So the Bretton Woods system was a quasi-gold standard. And under a gold standard, or even the Bretton Woods system, trade between nations had to balance. Because if they didn't balance under a gold standard, then the deficit country would have to pay for its imports by shipping its gold overseas. And since gold was money, if they shipped too much of their gold overseas, they wouldn't have any gold or money left at home, and their economy would go into a big recession, and they'd stop buying things from overseas. So trade balanced. So this system lasted up until 1971, and the Bretton system broke down at that time. And afterwards, they couldn't put together a new system. So things just started floating, driven by more or less market.
Well, that was Nixon. Nixon took America off the gold standard, didn't he, in 71?
That's right. Up until then, the United States had pledged that other countries, if they accumulated dollars, they had the right to convert them in the U.S. into the gold that belonged to the United States. But by 1971, other countries had 4 times more dollars than the United States had gold. And so it just simply wasn't possible to keep that promise. And afterwards, instead of all the currencies being fixed and pegged to one another, they all started floating. And then something very important happened, really starting in the early 1980s. In the early 1980s, the United States started running very, very large trade deficits, and which was unheard of because, as I said before, under the Bretton Woods system, trade between nations balanced. And these very large trade deficits really frightened all the world leaders because nothing like this had happened before. By the mid-1980s, the U.S. trade deficit or current account deficit was, I think, 5% of GDP, or 4 or 5% of GDP at that point. And so what this meant was that the United States was buying very large amounts of goods from other countries. And instead of paying with gold, it was just paying for these goods with dollars. So every year the U.S. had a trade deficit that threw more dollars off into the global economy. And they were accumulated by, well, let me move forward a bit. So from the mid-1980s, they tried to correct this situation by having the Plaza Accord.
That's right.
And there it was agreed that the dollar would be devalued roughly 50% against the yen and the mark. And that brought the trade deficit back into balance by 1991. But then China entered the global economy, and the trade deficit began to explode again. And it grew and grew and grew until it peaked in 2006 at more than $800 billion in that 1 year alone. That was 6% of US GDP. And today, the US current account deficit is $1.1 trillion. So this last year, that is, in 2024, it was $1.1 trillion, a record high. So that meant the trade surplus countries received $1.1 trillion from the United States that they wouldn't have received otherwise if we'd been on a Bretton Woods system where trade had to balance. And altogether, since the early 1980s, this cumulative U.S. trade balance deficit has amounted to $16 trillion. And that meant that $16 trillion went to the trade surplus countries. They literally received $16 trillion that they wouldn't have received otherwise.
Right. And that's because we were consuming their goods as we imported them
That's right. The
and
US,
paying for them with dollars. Yeah.
that's right. So this flooded the global economy with dollars.
Mhm.
And that's why we're still the international reserve currency. There are just so many dollars floating around in the world because of the US current account deficit throwing
Okay.
off the global economy.
Okay, so help me understand then this idea of exorbitant privilege, because it's not just the fact that we printed or created money. I mean, by the way, I'm going to ask some dumb questions, so just correct me if I get it wrong. But we've spent dollars importing goods, and those dollars have gone out. But somehow this has enabled us to borrow at extremely low interest rates, doesn't it? We've got this advantage that we can do that. Can you explain that idea and this concept of exorbitant privilege as well, please, in this context?
Okay, let me do that by using the example of a Chinese exporter or Chinese exporters. They sell their goods in the United States. They get paid in US dollars.
Hmm.
They take those dollars back home to China and they want to convert them into the local currency, the Chinese yuan. But if they were to do that without any sort of intervention from the government, converting so many dollars into yuan would push up the value of the yuan very sharply. So to prevent that from happening, the Central Bank of China buys all the dollars coming into China at a fixed exchange rate so that the currency doesn't go up. China doesn't want the currency to go up because if their currency goes up, then that will make them less export competitive. And their economy has been driven largely by export-led growth. So that's what happens. The exporters can convert their dollars into yuan, and they can do anything they want with their yuan. But what they do ultimately ends up in the banking system and causes rapid deposit growth in China. And because the banks then have so many deposits, they have to make rapid loan growth. And that creates a boom in the surplus countries, this credit creation. But what we're really interested in is the central bank. Altogether, China's trade surplus with the US last year was $300 billion. And at the peak, it was closer to $450 billion a couple of years ago. So last year, China got an extra $350 billion. It ended up in the central bank. But where did the central bank get the $350 billion worth of yuan that they used to buy the yuan? The answer is they created their own money. The central bank created their own money from thin air, just like the Fed does when it does quantitative easing. But in this case, they created their own money and they used it to buy these dollars. Now, once the central banks accumulate these dollars as foreign exchange reserves, then they have to do something with these dollars if they want to earn any interest on them. And of course they do. So they have to buy US dollar-denominated assets.
Treasuries, right? They buy treasuries.
Foreigners own $8.5 trillion of US government bonds, which is 23% of the total of all US government bonds. It's made it very much easier for the US government to finance its $36 trillion of debt.
Okay, this is the crux of the matter, isn't it? So this concept of exorbitant privilege is this idea that because we have a trade deficit and our dollars are going out of the country, the only thing for foreign countries' central banks to do with those dollars is to buy treasuries, which puts incredible demand on these American bonds, which forces down interest rates, right?
That's right.
Okay, so what's going on? Okay, so we got to the bottom of it.
But they also have bought Fannie and Freddie bonds and also stocks, pushing up stock prices.
And real estate, for that
And
matter.
real estate.
Yeah.
Especially, and the lower interest rates have helped real estate as well, and stock prices as well too. So the exorbitant privilege is the United States gets to buy things from other countries. Those other countries then get stuck with dollars that they have to give back to the United States. So one famous French critic of the system compared it with a game of marbles, at which at the end of every game, the loser has to the winner has to return the marbles to the loser.
Exactly. Well, but it's created this cycle or this flywheel that as our dollars go overseas, They have to be invested somewhere, so they come back here, and that's what forces down. And so I think that your thesis, and correct me if I'm wrong, you've described this international monetary system, and you call it the dollar standard, correct? That's the term that you apply. But you've also described it as being inherently flawed. So why is that? Where are we going with this? Why is it flawed?
Right. So my first book was written in 2002 and came out the next year. It was called the Dollar Crisis.
Mm,
And this is where I first elaborated this idea. And the flaw in the dollar standard is that it doesn't have any automatic adjustment mechanism that prevents trade imbalances, no matter how large they become. Whereas I mentioned before, the gold standard had an automatic adjustment mechanism. If you had to pay in gold, you couldn't have a big deficit because you would run out of gold, and then you wouldn't have any money and you would starve. So
mhm,
it adjusted automatically. But that's not the case in the US. The US, starting in the 80s, the US discovered it could buy as many things as it wanted from the rest of the world. And it didn't have to pay with a limited supply of gold or a limited supply of anything. It could just pay with paper dollars, which effectively meant paying in treasury bonds. And so
mm,
the deficits, even back when I wrote my book, 2002,
mm.
this created global imbalances. The trade surplus countries like Japan and China, as the dollars went into their economy, they went into the banking system there, where they got converted into a local currency, and they went into the banking system there. That
Mhm.
caused, because the deposits built up so fast, the banks had to have rapid loan growth very fast to match their deposit liabilities. And
Mm.
so the rapid credit growth in the surplus countries ultimately led to Japan's great bubble, which popped around 1990, at which
Right.
the imperial gardens around the imperial palace in Tokyo were worth more than California. And the stock,
Isn't that incredible? I'll share with you a funny anecdote, if you don't mind, just kind of just as a break. I was raising capital from Japanese investors for real estate, ground up real estate developments in Southern California. And my job was to present, these are all non-English speakers. This was before I spoke Japanese, so we had interpreters. And I was standing in front of this, I don't know if it was a whiteboard or whatever it was, had slides somehow anyway. And I'd spent so much time preparing this presentation. And I remember going through, and the price of the land that we were buying in downtown San Diego was an exorbitant $50 a foot at the time, $50 a foot at the time, which was just an outrageous number. And one of the interpreters, somebody said, "What's that number? 50." And it's a guy interpreter, and he said, "No, you've made a mistake. That's not possible." And I went cold. I mean, I remember feeling I went cold. And it wasn't because he thought the number was so high. He thought I'd put the decimal point in the wrong, that there shouldn't have been a decimal point. It should have been $5,000 a foot. And when he realized it was 50, that was the end of the presentation. Oh, it was okay, we're in. There was no further discussion about it. Anyway, sorry to interrupt with that anecdote.
no,
Anyway,
no,
it's
that's exactly
fascinating
right.
to hear what you say, though. Okay, so they were forced to lend, which dovetails into what I remember of that time, that they were coming over here because the banks were, "Please take our money," the banks were saying to them.
Right. At that point, the Japanese economy grew so large, it was uh, almost as large as, I mean, it wouldn't have been too many more years before would have been as large as the US economy. At
Hmm.
that point, the Japanese companies were buying up buildings all over Hong Kong, where I was living at the time,
Mm,
and everywhere else in the world, as you're pointing out. And the reason that Japan had this big Japanese bubble is because of their trade surplus with the US. That's
mm,
the reason. They had a very big trade surplus with the US. They got, trillions of dollars that they wouldn't have received from any other source that pumped into their economy and blew it into an enormous bubble that eventually popped. And the same thing happened with all the other trade surplus countries, Taiwan, and then the Asia crisis, which I experienced firsthand, Thailand, Malaysia, Indonesia, and South Korea, and later on China, now Vietnam, and soon probably India. All the surplus countries blow into bubbles.
So what is the, okay, So the moral of this story is America's vast trade deficit benefits America, but is blowing up the economies of countries around the world. But you've talked about it being inherently flawed. Is that the flaw? Does it go beyond that, Richard?
Well, so not only does it blow up the trade surplus countries, but because these central banks have accumulated the dollars through printing their own money, the central banks then reinvest this huge surplus back into the United States, blowing the United States into a bubble as well.
Because they're investing in bonds, U.S. government bonds, and in real estate and etc. I see. So it inflates. It's an unnatural inflation of asset values in the States. Is that right? And that pushes down interest rates as well. It keeps interest rates suppressed by having this huge demand, right? Because people want this asset. So
even in 2002, when I wrote this dollar crisis book, I said this is destabilizing the global economy. It's creating these bubbles. The US bubble is going to become so large that people just won't have enough income to finance houses, for instance. And sooner or later, this is going to lead to a financial system meltdown involving the banks, the Fannie Mae and Freddie Mac, or the insurance companies. And sure enough, not that many years long later, they all three blew up.
Yeah.
And had to be bailed out by the government with massive budget deficits, $1 trillion budget deficits, and trillions of dollars of quantitative easing. So when the crisis I was expecting, I thought that was going to cause an extreme, perhaps even a depression. But what we found out, or what I found out, is that there is such a thing as quantitative easing. It is possible for the Fed to create literally trillions of dollars and use it to finance trillions of dollars of government borrowing at low interest rates and to reflate this bubble. So rather than the bubble that I was writing about it in 2002, rather than it blowing up, they stopped it just in the nick of time from imploding into a new Great Depression and made it much, much larger. And
it came very close, though, in 2000. But it came very close, didn't it, Richard? I mean, we were staring. I remember amongst a group of professionals I used to meet with once a week, somebody saying, we are standing on the edge of a precipice. Let's hope we don't take a big step forward. Take a big step forwards to solve it in our attempt to solve it, basically. But okay,
people may have forgotten, but of course, Fannie and Freddie went bankrupt and had to be taken over by the government, and literally every bank in the United States would have failed if the government hadn't stepped in and saved them. And without deposit guarantees, that would have meant the Americans would have lost all their money, and the economy would have collapsed into a new Great Depression. We did hit 10% unemployment, but it would have been 25% unemployment as it was in the Great Depression, and there would have been no end in sight.
It was very frightening. I remember that. Let me just back up briefly before we get to the attempt to eliminate deficits under the current administration. You've talked about quantitative easing. Can you just explain exactly what that is? So we understand this idea of dollars and bonds and investors coming over, but taking the money, etc. What is quantitative easing during any time, but particularly during times of stress?
So the Fed, of course, has always had the capacity to create money, but when the crisis hit in 2008, they took this to extremes that had never been seen before. The amount of money that they had created up until that time, the total assets of the Fed was less than $900 billion. By the end of 2014, it was $4.5 trillion. And at the peak during COVID, it hit $9 trillion. And in one 3-month period, I think it's the first or second quarter of 2020, the Fed created almost $3 trillion in 3 months. So what does that mean for the Fed to create money? How does the Fed create money? The Fed creates money by buying. What it does is it buys government bonds and sometimes Fannie and Freddie bonds. Let's just talk about government bonds. It buys government bonds from banks. So that these are government bonds that have already been issued that are owned by banks. And how does it pay for those bonds? It pays for every bank, every commercial bank has a bank account at the Fed. And the Fed pays for the bonds it buys by making a deposit into that bank account. They're called reserve accounts at the Fed. But the thing to understand is when the Fed makes a deposit, it's not depositing money that already exists. The act of making the deposit creates the money. And so that's how the Fed creates the money and exchanges it for government bonds. And then the banks have reserves in their account. And they can use those reserves to go out and buy more government bonds or anything else they choose to do with it. And that when they buy more government bonds, that allows the government to finance its very large budget deficits at low interest rates.
Right. And this is this concept of printing money, isn't it?
Right.
Print money. And so the banks, so basically they are injecting liquidity. They're putting money into the economy. The easiest thing I think for people, and during downturns, it's a little harder to imagine, but during COVID, that's exactly what happened. The economy kind of seized up because people didn't go out and do anything. And so there was quantitative easing that pumped money, printed money, pumped it into the economy, literally sent checks to everybody. And then when COVID, all the lockdowns ended, everybody went out. There was this rush of spending, pent up demand, but also because of this extra cash, wasn't there? And that also stimulated acquisition, purchase of overseas product, goods and services, or goods primarily.
The government sent out stimulus checks to the Americans. And so that was the thing that injected the money into the economy. But where did the government get the money from? They had to borrow it. And who did they borrow it from? Well, they borrowed it in effect from the Fed because the Fed created money and bought the government's bonds. So if the Fed hadn't bought the government's bonds, the government would have had to borrow still to send out the stimulus checks. But the government borrowing so much money would have pushed up interest rates, and that would have done a lot of damage to the economy. So it was this combination of government sending out massive stimulus checks and the Fed effectively creating money to finance the government's borrowing to make that possible that prevented a new depression in 2020.
Okay, so Richard, let me ask you this then. So what you've described here is a flywheel, basically, that at the center of which is the United States, right? And the entire world is kind of dependent, has become dependent since World War II, on this flywheel of demand and money creation and lending, low interest rates, etc., from the United States. So if the Fed does its job properly, maintains maximum employment and suppresses inflation, why is it, and again, we're kind of getting back to this original question. You've talked about this, the dollar standard being inherently flawed. Why could this flywheel not continue spinning indefinitely as long as you keep inflation under control? Why does it fail? And why can't it just keep on going?
So the reason that all of this has been possible to go on for so long, normally having trillion-dollar government budget deficits and creating trillions of dollars of paper money in 20, the classical economic theory would teach that's a recipe for hyperinflation.
Right.
We didn't get hyperinflation because at the same time we had globalization, which I've witnessed firsthand in spending most of my career in Asia all of these years, starting in 1986. I've seen globalization up close. When I first moved to Hong Kong, soon afterwards, I would take trips into southern China and see factories literally as far as the eye could see into the horizon, full of 19-year-old women earning $3 a day. And so by buying things from people who make $3 a day, this pushes downward pressure on the price of all goods coming into the United States, or at least most manufactured goods coming into the United States. is extremely disinflationary or even deflationary. And so these deflationary forces of globalization completely offset the inflationary forces from the big budget deficits and the quantitative easing. And most of the time, up until COVID, the inflation rate was below the Fed's 2% inflation target. They were more worried about deflation than inflation. And that's because of globalization. So if globalization persists, we could continue with this system, maybe not forever, but for quite, a number of more decades, perhaps. But the problem is one problem with this whole arrangement is that it has deindustrialized the United States and caused the lifestyle of the middle class to stagnate, breeding resentment that ultimately led to a political backlash that resulted in President Trump being elected twice. And the middle class is not happy. It effectively led to MAGA. MAGA is not happy, and they're demanding that globalization end. And
let me just ask you something about that briefly. And this question is not necessarily with you, but it's probably going to get me into trouble with somebody. But we've got full employment, right? I mean, there's full employment. The entire country is employed. Everyone's got jobs. So this question of the middle class being disenfranchised, it's not the word you used, but that they're unhappy. I hate to say it. To what extent are they unhappy because they've been told they're unhappy? That's rhetorical. It's a very politically, obviously, oriented question. Yeah,
there are two sides to that story.
Mm.
They have more income than they had before, say in the 1970s, and they've got much better technology.
Mm-hmm.
But the thing is, they've lost their dignity in the sense that before they had good jobs, lifetime security, and felt that they were making progress in life.
Mm.
And now asset prices, home prices have been blown up to such extreme levels that the younger generation, or anyone for that matter, how can you buy a new home? Starter homes in California, or what? At least $1 million.
Don't even ask. I hear about homes in other parts of the country, Richard, seriously. People that say, oh yeah, you can buy a home for 400,000. Round here, that's barely a down payment.
Right.
In California.
So everyone's being priced out of the American dream, unless you're among what people like to refer to as the elite.
Yeah.
Anyway, so that's
okay. So I'll tell you what. Let's get to the Trump economic doctrine, and this again based on your the macro watch. I can't believe that your latest macro watch videos are exactly what I wanted to talk to you about. So the next question that you answer in that video is so why, and I'm actually going to read it straight from the website, why Trump's plan to eliminate these deficits could trigger soaring interest rates, crashing asset prices, and a global financial crisis. Okay. I know we should subscribe to the newsletter to find out. But there'll be more news coming out this year. Please do tell me the answer to this.
By the way, the title of that Macro Watch video is Trump's Tariff Policies May Still Pop History's Greatest Credit Bubble.
Okay.
Here's why. And indeed it may.
And this is from you, the man who predicted the global financial crisis. So listen up, listeners.
I'll just add that the presentation was made before the announcement that a trade deal was made with China.
Okay.
But I've made the video the following day with just two extra charts, two extra slides explaining the implications of that.
Okay. Which is why I'm going to try and publish this podcast in the next 5 minutes, as soon as we just in case something else changes.
It's a roller coaster.
It is, isn't it? All right, go on.
So President Trump really wants to reindustrialize the United States to help the middle class regain increase their standard of living. and get the jobs back in the US. And to do that, he wants to impose very high tariffs on all the other countries in the world and devalue the dollar. And this means that he also wants to bring the US trade deficit back into balance. And the problem is the trade deficit, the current account deficit, is the exact opposite of capital inflows into the United States. Every country's balance of payments has to balance. That means if the US has a $1.1 trillion trade deficit, as it did last year, then it also had $1.1 trillion of capital inflow going into the United States. This is mathematically required. This is not theory.
And let me just ask you a question.
Capital inflows.
Is that because when we pay 1.1 trillion for overseas products to import them here, those dollars go overseas and they have to go somewhere, so they come back to the States in terms of bond buying and real estate buying, whatever, it comes back into the States? Is that the principle there? It doesn't stay overseas.
That's right. That's right. I mean, you can think of this in this case as a family. If a family borrows, if a family spends more than it earns, then it either has to go into debt or it has to sell something. And that's the case here. If we have a $1 trillion trade deficit, we have to finance it somehow, either by borrowing or selling something. That's how it works. That's how it gets paid for. And so we have a $1.1 trillion current account deficit last year. Therefore, we had $1.1 trillion of capital inflow coming into the United States. And this is not the first time. As I mentioned, the cumulative deficit has been 16 trillion. And the capital inflows have been 16 trillion since the mid-1980s. This money that the trade deficit creates has created a global credit bubble that's unprecedented in history. It's created not only an everything bubble in the United States, it's created a global credit bubble, a global everything bubble. Everything is a bubble. And the fuel that keeps this bubble from popping is the dollars that come as a result of the trade deficit. If you take away the trade deficit, this whole global bubble implodes.
And so what does that look like? So let's just talk through that again. I love this 101 level. You're very helpful at this level. So the deficit, so what happens is we stop importing, and in theory we have a trade surplus, but let's just go to equilibrium, all right? So we stop buying goods from overseas, which means that we stop sending dollars overseas, which means that overseas or foreign central banks don't have dollars, so they don't buy our bonds. And so interest rates go up because we still have to finance, we still have to borrow. Like, just help me through this bit. Like, what's the logic cycle that gets us to soaring interest rates and crashing asset values?
It was very damaging for both the trade surplus countries and the United States. So let's talk about the trade surplus countries first. So whereas last year they enjoyed $1.1 trillion going into the trade surplus countries in total. If trade came back into balance, that means the rest of the world would have $1.1 trillion less this year than they did last year. And that means that their factories would be idle and their unemployment would skyrocket and their banking system, for instance, China has huge amounts of corporate debt, and the only way they keep this entire banking system from imploding is they make new loans this year so that the debtors can repay the interest on all of the money that they borrowed in previous years. But if you cut off this surge of liquidity that comes into their countries every year, then this is going to dry up their domestic liquidity and cause a credit crunch. So pretty soon you'll start to see corporations and individuals going bankrupt, and this will lead to a systemic crisis there, causing a very severe recession in all the trade surplus countries. Because China would have far fewer dollars, that means China would buy far fewer things from Malaysia and Indonesia and Brazil, not to mention America and Canada and the UK. And so all the trade surplus countries would go into shock and into an extreme recession with higher unemployment, which would make it much, and probably systemic financial sector crises that would, just crush their economies and make them much poorer and much less able to buy things from the United States. Now, at the same time, there will be $1.1 trillion less coming into the United States this year than last year. And so there will be far fewer buyers of US government bonds, and that will push bond prices down and push interest rates up. And there'll be far fewer buyers of stocks. So stocks will tend to fall. And so there'll be a liquidity shock in the United States as well. And in addition to the liquidity shock and the negative impact that will have on everyone to start with, the negative wealth effect that would result from that, we would also have a situation where the global trade with these tariffs would, because global trade would be collapsing, just as it did in the 1930s as a result of the Smoot-Hawley tariffs. Global trade would collapse, and so corporations would have much less profitability. And that would further damage stock prices and contribute to the negative wealth effect.
Okay. So first of all, this isn't likely to happen quickly, or is it? Like, so you wrote your book in 2002, and the real hit was 07, really. So about 5 years later, this bubble burst. Okay, so the world's changed a little bit. Things are moving faster. This administration is moving faster than any administration has moved. We have AI. Technology has advanced dramatically in the last 20 years, almost 25 years. So what is the timing of this, do you think? And actually, so actually point to to Trump administration's economic doctrine, particularly around tariffs, its attempt to eliminate deficits. What is the realistic scenario here, sitting here May 25, do you think? I'm really asking you to put your neck out a little bit, but it's okay. People don't only listen to this if you're dead right. No one will listen if you're wrong. In a few years' time.
The difference between 2002 and now is that it was really the private sector that blew into a big bubble. The property sector in particular in the US, it turned out there was a housing bubble that blew up.
Right.
And when the housing bubble blew up, then the private sector banks all blew up. So you could say that it was market forces that led to this bubble and to its implosion in 2008. And it was only the government that then came to the rescue in 2008 and kept the private sector from destroying itself completely. This time it's quite different. The private sector is not blowing up. The problem now is that the government has made a decision to blow up this whole arrangement. It is a government decision to make this arrangement implode. Although, so they must not realize, well, they're beginning to realize now that how serious things could become if they blow up the system. It's President Trump who decided to put up these very high tariffs. And the very high tariffs will do all the things that I described in global liquidity, create a global liquidity shock there and here in the US, and create a new depression. So as of a few days ago, things, actually, liberation.
Yeah, check the news now. Let's check the headlines before we speak too soon. Might have changed again. Yeah, so there's this reversal, but the thesis of reducing the deficit, can you articulate that? I know it's difficult to do, but when one has a particular perspective, it's difficult to articulate the other side. Right. But just explain to me briefly, what is the case for eliminating deficits through imposing tariffs. I know there's a tax component as well to generate revenues and reduce the deficit that way. But is your point that deficit is good? I'm not sure. I'm kind of losing the thread a little bit. At the one hand, the dollar standard is inherently flawed, but on the other hand, we can't kill the deficit. So is this, one way or the other, we're going to lose? Are we just doomed ultimately economically?
Well, so of course, 2002, when I wrote the book, was a long time ago, and my views have evolved over time. Effectively, to answer your question, I believe the bubble's grown so large now that if it implodes, the catastrophe will be so complete that our civilization might not survive it. So at this point, I think it's better to keep the bubble inflated, which I believe we can continue to do for many years into the future, and take advantage of this period ahead of us to come up with a solution to solve this problem, ideally by growing our way out of the economy, by growing our way out of the credit, the debt problem. And my most recent book came out a few years ago. It was called The Money Revolution: How to Finance the Next American Century. And what I advocated in that is, rather than allowing the bubble to implode, as it will if left to market forces, then we should take advantage of this new economic environment we find ourselves in, where it is possible for the government to have trillion-dollar budget deficits, and it is possible for the Fed to finance these deficits by creating money, all without having high rates of inflation, so long as globalization is working. We should take advantage of those facts and have the government borrow on a very large scale and invest very aggressively in new industries and technologies over the next 10 years in things like artificial intelligence, quantum computing, biotech, nanotech, robotics, neurosciences, and green energy. And if we do that on a multi-trillion-dollar scale, I believe this would turbocharge US economic growth and allow us to grow our way out of this crisis, rather than the alternative of austerity, which will ensure that the whole thing implodes and we all suffer enormously.
Or we could just build factories to make dolls and Nike shoes as well, of course, right? I mean, isn't that... He said, removing tongue from cheek, as he asked that question. So where is the... So if you were advising... Well, let's see. So what is the path that we are on with the trade doctrine, the Trump trade doctrine, this idea of heavy so-called reciprocal tariffs and heavy negotiations? If he were under your if he was taking your counsel, how would he be handling this situation? What would he be doing, and how would he be negotiating with these foreign countries?
So let's first talk about what the plan actually is, because a man called Stephen Moran in November published a paper called A User's Guide to Restructuring the Global Trading System. And it's turned out to be a blueprint for what they have done.
Really?
Since then. He's the president's chairman of the Council of Economic Advisors. So that's a very senior post in the president's administration. And so it was a three-step proposal. I mean, it's really audacious, and it's vicious in its ruthlessness. Here's the plan.
What's the paper called again? You can see I just opened my screen up here. What's it called?
It's called A User's Guide to Restructuring the Global Trading System.
Yeah, there it is. Okay.
It came out in November.
Okay.
And so it discusses the policy, what the policy should be. And it really it's a three-step plan with two objectives. Let me mention the objectives first. The first objective is to reindustrialize the United States. And the second objective is to isolate China economically and essentially wreck China's economy so that it will no longer be a threat to US national security, which it is at the moment, and increasingly so every day that passes. Now, the three-step plan to accomplish this is laid out very clearly. Step one is to put very high trade tariffs on all the other countries in the world. Step two is then to threaten all of our allies that if they dare to retaliate and do not fully cooperate with us, we're going to remove the United States security umbrella from them. And they're on their own. Poland and Germany can defend themselves from Russia. We're going to wash our hands of the whole mess and go back home. So that's step two. And step three is to, in a sense, convene a Mar-a-Lago accord in which we bully the terrified allies into agreeing to a big devaluation of the dollar, and also force them to also put up very high trade tariffs against China, so that we build a global tariff wall around China so that it will wreck China's economy and stop its growth. So that's the plan. So far, we've carried out step one, the very high tariffs. Step two, we've threatened to withdraw the US security umbrella from our allies. And now we're in the process of step three. All these trade negotiations that are going on with our allies, presumably they include a big component involving a dollar devaluation and forcing them to also put up very high tariffs against Chinese goods along with the United States to isolate China economically.
So why is this flawed, do you think? And we should start wrapping up. Actually, it's perfect time, but it's perfect timing anyway, yeah.
Well, it's flawed because for the one reason, if this does accomplish what he wants, I mean, for many reasons, I'm not the only person who's read this paper. Everyone in China's government has read this paper. Every hedge fund and every big bank knows this. So if they know that President Trump wants to devalue the dollar, they're all going to start selling their dollars before the dollar devalues, and they're going to start selling their dollar-denominated assets. And that's why the dollar has fallen over recent months. It's bounced a bit over the last few days, but it was down 10%. It could fall another 30 or 40%. And and that would involve a lot of selling of stocks and treasury bonds and all kinds
Right, and exactly. And also in my world, that would also suggest exiting foreign holdings of commercial real estate in the US as well, would it? Yeah.
Everything, all dollar assets. If you know the dollar is going to devalue, you want to get rid of all your dollar assets as fast as possible. So that's bad. It would also, if he succeeds in bringing trade back into balance, it creates a global liquidity shock that causes a Great Depression. And finally, it's bad because in the sense that China understands this plan. They know that Trump wants to build a global tariff wall and isolate them behind it. And so they must view this as essentially, the Chinese leadership must view this as essentially an act of war and an existential threat to the Chinese Communist Party. And they have the means to retaliate in economic means and military means to inflict enormous pain on Americans if they choose to do so. And so it's bad for all of those reasons.
Where do you think we're headed, Richard? I mean, I know where we're headed. We've got to wrap up in a minute or two. But apart from that, where do you think this is going to play out? Again, we're talking mid-May 2025. I don't normally date stamp these things, but we have to at the moment. Things are changing so quickly. So how's this going to play out over the next months?
For a couple of months already, once all of this became clear, I mean, I think what I've been saying and what I still believe is that the pain for the United States is going to become so severe in terms of higher inflation, rising unemployment, shortages of goods on the shelves, and the loss, since we've alienated our allies, they're going to be less willing to hold US dollar assets and treasury bonds, which should suggest that there should be upward pressure on government bond yields and interest rates in general, and falling stock prices. This all is going to be so painful for the United States that ultimately the president will have to completely reverse course and abandon these objectives altogether. And indeed, that's what we're seeing playing out in front of us. First, after Liberation Day, 1 week later, he dropped all the reciprocal tariffs because the bond market was about to
Implode. Yeah, it's appalling. Yeah,
implode,
very
go
frightening.
insane, and the dollar was falling so quickly. And
Mm.
now he tried to call China's bluff and put up 145% tariffs on their goods. And then he discovered that pretty soon the Americans aren't going to be able to buy anything at the grocery store. I mean, at the, all the shelves are going to be empty and prices are going to be much higher. So China, before China, they're preconditioned to having trade talks with the Trump administration, was that Trump drop all of the tariffs. And in fact, that's what happened. Trump folded in light of this coming lost Christmas and took away all the tariffs that he'd put on them before. Now they're back down to the 10% tariffs that everybody else is facing, plus another 20 related to fentanyl. But effectively, he blinked. And so they are being forced by economic realities and economic pressure to reverse these policies. Now, it's unclear whether how long, like you keep saying, we should glance at the TV to see what's happening while we've been discussing, because everything could change in the next tweak, in the next tweet.
Right.
But ultimately, I think he's going to have to, settle for much less than far, far less than what he'd hoped for.
But this damage has already been done, hasn't there, Richard? I mean, in terms of the full faith, I think of this term, the full faith and credit of the US government. For overseas investors, central banks, and governments are looking upon the United States as a less safe haven for their capital, aren't they? And then we're beginning to see that drift now into other currencies, into other countries' economies away from the US already.
And we still do have these ongoing negotiations with all of our trading partners, including China. And the key goal is going to be to try to make them agree to a sharp devaluation of the dollar, as laid out in Moran's plan, and also to putting trade barriers against Chinese goods. In the FT this morning, there was a story about China rebuked the UK for some such thing in its recent deal with the US. So there's still a possibility that what Trump does accomplish is going to reduce the size of the trade deficit, which will reduce global liquidity. And as the title of my most recent Macro Watch video suggests, still has the chance of popping history's greatest credit bubble.
Right. I would love to continue talking to you. This is absolutely fascinating to me. I do think that these issues are so far from anybody's mind here. I'll just tell you that. I mean, in my world, this doesn't exist. Everyone's just chugging along like everything's fine. You see the stock market is back to where it was Liberation Day or whatever. It's people, I don't know. So maybe, I like to say well, I think the same as you do, I have the same view. Maybe I'm wrong. It has been known, but one has to prepare. You've got to be prepared. And so, with that in mind, if I can ask you, and by the way, if you're up for it, you don't mind getting up as early as you did today, he said, rolling his eyes, as late as it is here for me. Maybe we can reconvene, much later in the year. Let's see what's going on and kind of reflect and look forward again, provided everything's still running at that time.
I would like that.
Let me I'll finish with 3 sign-off questions, if I may. Quick ones, just quick bullet feed kind of questions. So, what are the market signals that you personally watch and you suggest people in the United States watch that give you early warning shifts to kind of seeing things move dramatically quickly if that is what happens?
Well, look, sorry, before I answer your question, let me just wrap up what we were talking about before.
Oh, please do. Yeah.
It sounds very, very doom and gloom.
Yeah.
But in a worst case scenario where the bottom does start to drop out from the economy in a global financial crisis like we had in 2008,
Yeah.
then I don't think the bottom will drop out, because at that point, they'll do what they did in 2008 and 2020. They will then have, $5 trillion budget deficits, and the Fed will create, another 10 or 20 trillion dollars, and they will reflate the bubble again. But so it's not going to end in unless there's complete stupidity in the economic policy makers. They will reflate the bubble. But if they do that, I mean, that's a better outcome than a new Great Depression. But if we do that at the same time that we have trade tariffs, that's going to be very inflationary. And if it's very inflationary, of course, that creates problems, but it also is a good thing. If you own a mortgage, a big mortgage, and have high rates of inflation, it kind of evaporates your mortgage debt, right? But also high inflation also evaporates the US government's debt. So there are a lot of bad things related to inflation, but there are some good things. The bad things are obvious. Prices rise, and that tends to be hard on a lot of people. And it also generally is not good for the stock market. And so I'm not predicting that the world is going to end. I'm just going to predict that the current policies may require another massive government intervention to prevent the world from ending. So it's not. So I'm not just a doom and gloomer. I'm just try to be realistic. This is how it would unfold. If things get really bad, they will have to reflate it again.
Yeah, but it's also going to depend on our ability to sell these bonds and US assets to overseas central banks and investors primarily, right?
That would be good, but if they don't buy them, the Fed can buy them all. There's no limit as to how many government bonds the Fed can buy.
That's printing money, and that's how we get to hyperinflation as well. So it's
particularly if we don't have globalization holding down prices.
right. Fascinating. Gosh, thank you so much. I mean, seriously, I've been scratching my head. I mean, I read a lot, and the more I read, the more I find I'm confused. Actually, by it all. But I've been, it's been very interesting talking to you. These questions, I don't know, these last ones. I suppose, let me just ask you this. Is there anything in particular watching for that would be... Oh, actually, yes, let me ask you this. So for somebody who is in America now, who is holding dollars, right? They've got cash in the bank, and they're holding dollars or they're holding dollar assets. What's your advice to them over the next, this is not financial advice, nor it's anyway, you're in Thailand, so no one's going to come after you there anyway. But what would you be saying to somebody? How should they be thinking about what to do with cash today, dollar cash?
Every individual has different different financial and personal situations. So it's difficult to give advice without knowing the individual's circumstances. But in general, I mean, this is no revelation, but a broadly diversified portfolio truly is probably the best long-term strategy, including, I'd go pretty light on bonds these days, but in terms of it, I liked rental property, a piece of land with a house on top that you can rent out. And I like gold. Since I wrote The Dollar Crisis in 2002, the dollar has lost 90% of its value against gold. That will probably happen again over the next 25 years. And if gold goes up, land will go up because they're not making any more land. And stocks, I think everyone should have stocks in their portfolio as a long-term investment. I think people with dollars, if they have some level of sophistication, it might be a good idea to convert some of your dollars into yen, for instance. The yen may very well appreciate over the next year. Taiwan dollar, I believe, jumped 6 to 10% in 2 days.
Crazy. Yeah, amazing, right?
And Trump wants to see the dollar decline. So if you just hold yen and the yen appreciates by 10%, that might be a good return this year. So things like that.
Richard Duncan. Right. You wanted to, so you've got a special offer, haven't you, for our listeners, Macro Watch. So what is Macro Watch and what's on offer today for our listeners?
So MacroWatch is my business. It's a video newsletter that I sell on a subscription basis. Every 2 weeks, I upload a new video discussing things like we've been discussing today and how these events, these important events happening in the global economy, how those things are likely to impact asset prices, stocks, bonds, properties, currencies, and commodities. I've been doing this now for 11 years. And I hope your listeners will check it out. They can find it on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they're interested in subscribing, they hit the subscribe button. They'll be prompted to put in a discount coupon code.
Okay.
If they use the code soon, like talk soon, they can subscribe at a 50% discount.
Very
And I'm
nice.
sure your listeners will find this very, very, very affordable. They will have immediate access to all of the videos in the archives, more than 100 hours. And they'll also have a new video every 2 weeks. And if they've been subscribed this year, they would have known already everything that we've discussed today. And so it's so exciting what's going on.
It
And
is exciting.
I try to explain all of these things very simply. I say a picture is worth 1,000 words, so I use lots of charts. And I explain, the economy just doesn't work the way that it does when dollars were backed by gold. It works very differently now. As I mentioned, trade deficits wouldn't have been possible if we'd been on a gold standard. Our economic system works differently than it did before. So that my goal in Macro Watch is to teach people how the economy really works in the 21st century in this post-gold standard world, and teach them in a way that's very simple and easy to understand. So I hope they'll check that out. That's richardduncaneconomics.com. Subscribe to Macro Watch and use the discount coupon code soon.
Fantastic. And Richard, I'll include a link to that I build a show notes page for the website. So I'll include that. And then I'll also publicize, if it's okay with you. I'm quite active on LinkedIn. So I'll promote the podcast on LinkedIn, and I'll also include a link there as well. And I'll send you, are you on LinkedIn? You're on LinkedIn, aren't you? Are you on LinkedIn?
I am, yes.
Right,
Yes,
fine. Okay, so I will let you know when that goes out on LinkedIn. And if I forget to put the link into MacroWatch, remind me, and I'll put it in on the LinkedIn post as well. Can I share the coupon on LinkedIn or not? You don't want me to do that?
Yeah, no, share the coupon would be fine. Yes.
On LinkedIn as well? Okay, good.
Soon.
All right,
Yes,
fine.
we'll
We'll get this. Seriously, because things are changing so rapidly. I'm gonna try and get this published. Probably, what day is it today? Tuesday, Wednesday, your time. Sometime early next week. Quickly. Anyway, we'll get it turned around.
So when it's available on your podcast, let me know, and I'll also try to promote it on my social
All
media.
right, I will do. Yeah, no, you'll get an email from me for sure. Richard Duncan, Macro Watch. What an enormous pleasure meeting you. Thank you so much for your time today.
Adam, I've really enjoyed meeting you too. This has been fun and interesting. So I look forward to the next time. Thanks again.
All right, that was Richard Duncan, founder of Macro Watch. Richard, what an enormous pleasure meeting you. Thank you so much for spending your time. You are a very famous person and very highly regarded on the world economic scene. So I'm quite flattered that you joined me. Thank you so much. And thank you too, dear listeners and viewers, for joining me today. If you got even half what I got out of our conversation today, then you are way ahead of the curve and are better informed than just about anybody else, actually, that I know in our commercial real estate world. It is the things that Richard shared insights on during our conversation have direct, immediate, and profound impact on our investment decisions. And yet most people just kind of trundle along oblivious. So hopefully you got some good value out of it like I did. I really enjoyed the conversation. So Thanks for joining me today. Thank you, Richard, and thank you, dear viewers and listeners. If you've not signed up to my newsletter, go to gowercrowd.com and hit the subscribe button. It's totally free. You can always unsubscribe and you'll get immediate access to these podcasts, analytics, and occasional goodies about AI and other good stuff about capital raising once in a while as well. All right, that's all I've got for this episode. Thanks again for joining me. Until next time, this is Adam Gower signing off.